Hello, and welcome to the 2020 Economic Update and Investment Outlook. I am Melissa Joy, founder and president of Pearl Planning, and I'm joined by Melissa Fradenburg from Pearl Planning Grosse Pointe. She's a financial advisor here, and we're so glad that you're able to attend this session. Getting right into our agenda, today we are going to be talking about what is occurring with coronavirus COVID-19 in the pandemic and the reopening process, as that is closely related to the economy. Then we will go into medical advancements in progress, followed by economic outlook, and we're going to describe that as the K economy. And then we're going to talk about stock markets and what we see is occurring there, followed by some suggestions that we have for how you can act now. And then we want to make sure that there's time for questions for from anyone in our audience. So without further hesitation, let's go ahead and dive in. First, we have a little bit of a extra step that we want you to take if you have questions, which we strongly encourage you to interact and ask. But we would ask that you send them in an email format to melissa@pearlplan.com. I'll be checking my inbox to make sure that we are able to answer those questions. And we will also have a prompt at the end of the presentation so that you know, again, where to send them. That just allows us to keep those questions on record for compliance purposes. So thanks for your patience with that. And then I wanted to share with you a little bit of information about where we're getting our information. So for those of you that are familiar with the investment strategy here at Pearl Planning, we have, from the bottom up, we select our securities, our mutual funds, and exchange traded funds through our own internal process, but we use the investment information, the economic and technical information that we receive from Raymond James. So we love that we have this broad and deep bench from Raymond James that goes all the way from a chief investment officer of a Fortune 500 company, Larry Adam, all the way to having public health and public policy analysts who can give us information day to day that is much stronger and deeper than any one smaller boutique registered investment advisor or wealth management firm. So much of the information here in the presentation is both our perspective, but also the research and due diligence and analytics of Raymond James. So we wanted to share with you part of that process, which we think has worked very well as we've gone into the difficult market that we've had over the last 3 months. They've been a voice of reason and a wealth of information. So without further ado, let me introduce my colleague, Melissa Fradenburg. Melissa Fradenburg, let's dive in on COVID-19 update.
Great. Well, let's start off with some positive news. How about that? If we look here, that's always good, right? So if we look here in the United States, testing is up. We're actually at about just over 2.5 million people per week and growing towards that 3 million mark. And the other part of the chart on the left-hand side that is good news is the number of positive cases is also going down. And at Raymond James, the healthcare analyst, Chris Meekins, that was sort of the goal he's been talking about all along, is to get to that 3 million mark in testing per week. And then the under 5%, which we are just about at now, as far as positive cases. If you look on the right-hand side in that chart, you'll see along the right-hand side chart, but the left-hand side shows the number of tests. And you see that the correlation shows that obviously the number of cases goes up, the more testing that is being done. But if you look at the bubbles, the size of the bubble there shows the deaths per million in different countries. And if you look at the United States there, we're at 266 deaths per million, which obviously no deaths are a good thing, but you see that that number is relatively small compared to some of the other countries there. So that is good news on that front. And when we look here, the chart here of the United States shows that the blue states, the dark blue and the light blue, meet at least 2, dark blue or 3 of the criteria set by the Trump administration for reopening. And there are only 3 states left that only have 1 criteria. But either way, states are opening regardless of whether they're meeting that criteria. some faster than others. And if you look here on the right, it shows, you'll see there's actually 48 states that have opened outdoor recreation, 35 states that have opened restaurants in some capacity, 39 states that have opened personal care, which would be beauty salons. I know a majority of our listeners right now are here in Michigan, and you can tell from our hair that that is not the case here in Michigan, but we are, again, slowly opening. And what I want to point out here is not only are states reopening, but there are 4 states, Georgia, South Carolina, Florida, and Alabama, that have fully reopened a little over 2 weeks ago. And the good news there is we have not seen a significant spike in cases in those states that have fully reopened. So again, positive news when it comes to the equity markets.
Yeah, and it's interesting because this is changing day to day. So we took this information, we compiled the information for this presentation as of last week, and it almost feels like we need a 24-hour refresh cycle because so much is changing so quickly. And I think that access to data, analytics, and information is critical at this point. Certainly we're not health experts, but we are relying on the information that public policy experts are telling us to watch for, and we're appreciative that we have Chris Meekins, who has a finger on the pulse of public health, not just over the last 3 months, but over the past years. So I wanted to pay a little bit of attention to medical advancements, because I think that when we've seen major market movements, it's often because there's either good news or rumors of good news. And the good news seems to be outweighing negative news when it comes to unemployment, et cetera. And so paying attention to some therapeutic and vaccine developments is going to continue to be a critical component of watching markets over at least the next 6 months. So there are 2 therapeutic target type trials that are intended to increase the ability to combat the virus once people unfortunately have contracted it. One is remdesivir and the other is Regeneron. Both are in trial periods right now, and you can see the market is reacting to good news very quickly. Of course, this is not a comprehensive list of all the attempts at therapeutic treatments. It's just some that are believed to have more potential. But we're still in a waiting period, so we're far from having good therapies to treat infected patients. On the vaccine front too, there's varying degrees of estimates for when there will be vaccines, but what we do know is that there are lengthy trial phases, which we have, kind of a Herculean effort in the US as well as around the world in attempting to get through phase 3 so that vaccines can be available to the general population and public, but it's still a wait and see type of environment. So that is something that we are certainly not acting as healthcare experts, but we're paying attention to, and feel fortunate that we're receiving this information to continue to watch. So I suggested that markets, and I particularly US stock markets, are reacting very positively to good news and negative news, especially, the unemployment rate is what sticks out to me, but the economic numbers that are going to be coming and have started to come through are equally troubling, are a different story. So, I love this cartoon because it tells the story that we are all seeing in the news from day to day. Markets seem to have been going up after a big plummet in March, while the economy numbers are just in a free fall. And specifically, unemployment rates have gone from almost full employment to 20 to 25% of the workforce not working right now in the matter of weeks. And those numbers continue to decline. And I think the information that we're going to be providing here is going to help you to understand the why as to how markets are reacting and how is it even possible that stocks are doing what they're doing. So we started to hear the alphabet soup of economic explanations at the beginning of this correction. And when we all started to realize the economic impacts of a virtual shutdown of the US and world economy. And many people go to a V or a U or a W-shaped recovery. And when you talk about the shape of a recovery, that's talking about where the economy is going in terms of economic output. So in a V-shaped recovery, there would be a sharp decline followed by a sharp recovery. And that often is considered to be kind of good news if you already know that you're heading into a recession. Conversely, a U-shaped recovery, you would bounce along the bottom for quarter over quarter or considerable period of time. I think it would be reasonable to suggest that 2008 and 2009 were a U-shaped recession. In a W-shaped recession, you know, you're bouncing back and forth. You have some fits and starts. So down, then up, down again, and then eventually a recovery. But we love how Raymond James has broken things out and described a K-shaped recovery, because there are different circumstances for different parts of our economy, different sectors. And so we've just taken 4 examples here to kind of explain that K-shaped recovery. So there are 4 points in this K-shaped recovery. One of them is straight through the roof right away. And you can see that in the K that's in the part of the K that's in the top left. So in this case, we're looking at e-commerce, and people don't want to go into stores right now, or they are not able to because stores are closed. And so, you know, the reliance on services like Amazon, online pickup from big box stores, or even your grocery delivery services, all of those rose an estimated 14% over the last 2 months. So there are sectors of the economy and areas where things are very flush. But then the losers in that scenario, it's kind of a zero-sum game. We take an example of clothing and clothing accessory purchases. You're not able to go into stores to try things on. That's something, while there was a e-commerce presence, it also was very brick and mortar. And we see an 80% decline in clothing and accessories. And I can tell you, you know, who needs a spring wardrobe when everybody's dressing in shirts and sweats and a t-shirt nowadays? I put on dress clothes today, and it felt like a strange thing to be doing during the pandemic. So there's a variety of factors that are contributing to this, but there are certainly sectors of the economy that are just plummeting. Then we have the section that had the decline, but seems to be progressing forward, where there's growth. And the example that we're using is home maintenance and spending. So if you think about it, we are talking about going to Home Depot because you're spending 24/7 in your 4 walls of your house. You need to turn a room into an office. And frankly, if you're going to spend all your time at home, you might want to invest in some of the projects that you thought would be a good idea over time. And you've got time on your hands as well. So that's an example of areas that really got hit up front, but are seeming to recover pretty quickly. And then you have areas in this K that are going to continue to be going down, but then there's also potential for recovery. So we are using the example of airline transportation, where there wasn't a secular trend that as a predecessor to this, like there was for e-commerce, where you know, the Amazons were really looming to threaten your brick and mortar stores. But of course, there's going to continue to be a disruption as people are uncomfortable, at least until there's a vaccine or more safety measures, to doing the type of travel they'd be doing this summer or even into next year. So you can see that there was a decline in airline transportation of at least 50% in March. I think that, you know, continues to be bad numbers, but once we have some additional information, the possibilities will reopen. So you would be waiting in those parts of the economy. So there's disparate outcomes occurring, and that fits into what we're going to be talking about in terms of stocks as well.
And what we're seeing here, as Melissa mentioned, is increasing dispersion. So what that means is both with sectors, industries, and individual stocks, there is a widening between the best performing and the worst performing. So on the left-hand side, we look at sector dispersion, and you see that the best performing sectors are technology and healthcare, no surprise there. And if you look at the difference of about 41% between that and the worst performing sector, which would be the energy sector. And then you see, as Melissa mentioned, we compiled this last week to get this ready for you. And even more so, that dotted line through the chart on the left-hand side has moved up a little bit further as we've seen a continued rally there. But if you look at the industry dispersion, the best performers, which are in the circle there, internet retail, wireless telecom, software, biotech, metals and mining, and tech hardware are all positive. Whereas you have, again, that dispersion of about 87% between that and the worst performing, which are banks and airlines. And even on the individual level, if we go to the next slide, and you see here in stocks, there are 418 companies year to date that are negative in the S&P. And the difference between those, the best performing stocks and the worst performing, 166%. So that is a huge, again, widening. And if we look at the previous bull market that we've had, a lot of the index funds have outperformed, but this does make a case for active management or stock picking in this type of a market where there is such a large gap between the best and worst performing individual stocks.
Yeah, I'd mention
anything. Yeah,
there's kind of a duality because both the wide dispersions, typically you're going to be thinking active management, seeking out the top half of that K-shaped recovery, the sectors that are affected there. But then also there's been a tendency toward the biggest companies getting bigger. So it just so happens that you saw energy through the floor. Well, energy is a much smaller component of the S&P 500 than it was 10 years ago, just because of secular trends as well. So there's both a case for active, but also cap weighted, weighting by the size of the company indexes have also seemed to be working, which is part of the story of how good things have been in the markets. So this is just a little bit of another way to slice and dice different parts of the country. And it shows how broad, kind of the differences of companies are. So this is a look at different industries within the S&P 500. It's put together by KPMG, and I took it from Twitter. And there are some sectors that are just going to have a hard reset, especially if they're significantly leveraged. Real estate investment trusts, how many corporations are going to want to re-up or expand their leases when half of their workforce can easily work from home? Oil and gas is another area where there's just lower demand, but there's also kind of changing dynamics even before we had COVID-19. Then on the flip side, you can have a surge in, internet media, some of the life sciences and healthcare sectors of research. And then you have certain areas, and I would put wealth management, our kind of world, as one of them, where things will pretty much stay the same, especially in the service kind of areas. So there's a more clear, delineation between the outcomes than in an 08 and 09, where everybody was just kind of floored by what was occurring in the economy.
Another trend we're seeing here, or a positive, I should say, is that companies are still very cash heavy. And you see, obviously, we've come down a little bit since those highs a few months ago, but right now it's estimated of about 1.6 trillion in cash. So the areas that have the most cash would be healthcare and telecom. But this is a good thing because, again, as far as a recovery goes, if you have companies, not only do they have higher levels of cash currently, but you're also seeing them, continue to conserve cash, and that comes through in dividends. You'll see 50 of the S&P 500 companies have cut or suspended dividends, which means they are, again, maintaining a large amount of cash.
Yeah, and I would say that this is a good indicator of corporate health, which is a differentiator between the last significant economic disruption we experienced in 08 and 09, where everything was more leveraged. So we've been coming out of a lower interest rate environment. Companies have been conservative. They haven't been doing the capital expenditure. So that's certainly relevant. So when we look at kind of forecasts for what's going forward, it looks like over the next, this is a consensus estimate of what analysts think earnings are going to be over time. You know, red is bad, green is good. So as we anticipate the rest of this quarter and earnings that will be coming out in July and August, gosh, it's hard to predict that there will be good news. But earnings that are less than 42% down would be a surprise on the upside, just really crushing earnings estimates. And then year over year, the predictions are, and certainly this is like an even murkier forecast than I've ever known, because so much is dependent on whether there are stay-at-home orders in place around the country or if there's a surprise on a new vaccine. So, take all of this with a grain of salt. But the assumption is that throughout the year, there will be dampened year over year earnings, followed by a recovery off of very low numbers in 2021. We think in terms of the S&P or, before that, the Dow Jones Industrial Average. And it's easy to forget, I should say, that stocks are a much broader, they have much broader characterization than just the components of the largest companies in the United States. So I wanted to take a minute to talk about valuations around the world and explain a little bit about what we're seeing in the numbers there. First, I want to look at this chart on the left. This is global valuations. We take these numbers from JP Morgan, and you'll see typically the valuations of companies as expressed by price divided by earnings is about 16.3% over the last 25 years. And there's been a huge range. We had the low in March of 2009 where things were extraordinarily cheap, and a high the high is probably in the late 90s. But right now we have pretty high numbers, and you're thinking, gosh, how can they be so high? Because we just had, these horrible economic numbers. Well, that's exactly the reason, because the assumption is that earnings are disappearing and the prices haven't gone that far down, especially we refresh these numbers. So these were as of May 26th. So the US is looking pretty darn expensive. The rest of the world has not performed quite as well as the US in this decline, but they were also cheaper to begin with. So the next bar from the left to the right is the developing markets around the world that are not the United States. Their valuations have tended to be lower, but they also are elevated above the typical valuation right now, but much closer to their normal valuation. There may be a little more opportunity in the rest of the world. When you get specifically into Europe, it's trading right around its trend line. And of course, there are disparate outcomes in Europe depending on each economy and how they fared in stay-at-home orders. Japan looks dirt cheap, although Japan has looked dirt cheap for a long time. And then emerging markets were a preferred valuation kind of darling leading up to this, and they also their numbers and their valuations look very, very low. So it's important to remember that both there have been different outcomes up to this point, but there may also be different opportunities and changes in leadership as we emerge from the pandemic in the future. And we do not want to eliminate our reliance upon diversification as part of our process. Then looking into the US market too, we described how looking at different sectors tells a story about how stocks have been behaving as well. And both over the last, or in this quarter, which I would characterize as kind of the recovery point, as well as year to date, there is a delineation between growth companies versus value companies. And you notice growthier companies are often those technology companies that seem to be the leaders versus value companies. I mean, energy goes right into there, as well as utilities. So this is a continuation and extenuation of a trend that has been going on for years. You can see this is going back to the market peak of October 2007, large company growth up 250%, small company value only up 54% since the market peak. And since the bottoms, large growth was up 600% versus small value only up 280%. So we've had trends that are only extending, which are also relevant. It factors into the returns of a diversified portfolio, but it also factors into the potential for future returns.
And this here is just another way of looking at that trend of growth over value. You see on the left-hand side, over the last 15 years, growth has outperformed value significantly, and both in a total return and a price return. And then on the right-hand side, you see year-to-date growth has continued to outperform value.
So I think that I love this, we take this directly from Raymond James, but it helps to explain what is kind of going on in the economy. Melissa, do you want to describe, kind of what you see as these kind of decision rules for how the markets may behave?
Yeah, I mean, everyone wants to know, right, what's going to happen going forward. So I think this is a great way to break it down of potential catalysts as well, for positive returns and potential catalysts for negative returns. Because as Melissa said, it's anybody's guess exactly how we're going to go here moving forward. But if we look on the left-hand side at some of the positive things that we have, obviously an aggressive monetary policy and fiscal policy that we've seen, as that continues, those are positives that are going to continue to drive the equity markets up.
And I would also mention those are almost immeasurable, like they're almost impossible to comprehend when we were talking about how accommodative the Federal Reserve is. And we were talking about how much stimulus has come through in the packages thus far, in the trillions of dollars. It's almost incalculable to understand how supportive they are of the markets.
Right. The other positives would be, as Melissa touched on earlier, the development of a therapeutic or a vaccine obviously would have a very positive effect. And then as we see the number of cases go down, as well as that death toll go down, we should see less of coronavirus dominating the nightly news, which again will have a positive effect. As far as those potential catalysts for a negative effect, obviously if we have a second wave of cases as states open up, if we have bad news on therapeutic drugs or vaccines that are in trials, or a delay in a vaccine, that could obviously have a negative effect on the markets. Of course, political risk with an upcoming election, and geopolitical risks that we've had all along with China and the rest of the world, of course, could also have a negative effect going forward.
Yeah, and the reality is that we've had, everything was kind of dominated on the negative side for the month of March. In aggregate, since then, there's the two big plus signs on the positive, plus some rumor mill plus signs on the development of the therapeutic vaccine have kind of dominated. And we would anticipate over the next months that you may have a ping pong effect where you're going back and forth before you can kind of move on and get past this point where there is any other news that's relevant other than public health crisis. So at the start of this downturn, we had developed in conjunction with some advisors in the UK and this Emoji guide to investing. And gosh, I think you could call it the Emoji guide to the pandemic as well, because it's been an emotional roller coaster just hearing about the news, facing the reality that both our economic lives, but more importantly, our personal health has been so at risk and impacted. And it is a ride. Like, you are on a roller coaster where every day can feel different. And if you look, this mimics what we experienced in the cycle of being an investor, in the cycle of full markets. So we already had kind of a source code to think about how our mind is responding to this information. Going into January and February, we were at and near market highs, and life felt pretty darn good. People feel good about the future, feel good about their prospects. But then we quickly, over a matter of days and weeks, went, in a 30% free fall in terms of stock prices, but also in terms of our sense of reality, which you can't even put a percentage of how much our, kind of future and outlook have changed over that period of time. And with that comes anxiety, comes fear, comes anger, comes all sorts of emotions. And what we know through, the experiences and history of being an investor is that the best way to react as someone making decisions on investments is to be impartial, neutral, and devoid of those emotions, which is frankly is impossible. But we do have, kind of some strategies to combat it. But I think one of those is just to acknowledge this roller coaster that we're on and be willing to take your pulse to say, I'm kind of having an angry emoji kind of day, or I feel sick to my stomach because the news is so bad. Recognition is a way to provide space from those feelings and your decisions and behavior. So I think managing from here's kind of 4 takeaways I want you to have as you think forward, both as an investor and, if for life decisions, if you want to take them with you that way, that's great too. I wrote a piece that you'll see in our next monthly newsletter that's called 5 Predictions for the Future After Coronavirus. And one of the things that I mentioned in there is it's not different this time. I think this is a trick that we all fall for where, we think the world has completely changed. There's a new paradigm. This time is different. And I have fallen for that as well. I'd say, the 2 to 3 years after 2008 and 2009, all I did was look for the next piece of bad news. And that's not predicting that the future is going to be much better. It's just saying, this, we don't know what uncertainty is coming next, but there is a resilience to our humanity and to our culture and the societies of the United States and around the world. It is not different this time. And in fact, the thing that I relate to people when thinking about this is look back on old historical headlines from 1918 when the most significant pandemic we've seen both in the US and around the world. You see headlines that could be written in 2020. So don't assume that the world is going to be completely altered. Also, process is your friend. So we feel fortunate that we have an investment process that we did not alter or bail upon during this cycle, and we will continue to manage with that process. That a process allows you to have decision rules for your behavior. It allows you to invest within a paradigm, and you don't have to go looking for the antidote to the investment market when you get to a point like this. It allows you to maintain through. Now, process needs to be coupled with our next point, which is to keep your financial house in order. Financial planning investment is only a part of financial planning. So we want to remind you and encourage you that good, sound financial decisions on things you can control, such as how much you save, how much you invest, how much debt you have, how you spend, all of that allows you more time and patience with your investment. And of course, that's the type of work that we do with you on financial planning and in much of our service offering with you is to keep that financial house in order. But also, even though it's not different this time, don't assume that every trend, especially those that are kind of stretched, will go on forever. So we use rebalancing within our investment process to make adjustments. But when we describe that large growth companies have dominated so much over the last, not only year to date, but over the last 15 years, at some point there will be a reversion to the mean. So don't get caught up so much in that you kind of bail on your process. I just want to add something else from the philosophical wisdom of a meme, which is that, all of us are kind of in the prediction market right now of saying, here's what I think we should do, or here's what I think is going to happen. And I think that's part of the human condition. When there's uncertainty, you feel really uncomfortable, and kind of latching onto an idea and forecasting makes you feel better. And so I know that we're not going to be able to eliminate that, although you probably heard me say until I'm blue in the face that we don't make predictions, at least when it comes to investments for the future. If you hear us doing that, ask us, have you changed your philosophy as an investor? Because it's just not what we do. But I would say that you should feel comfortable that what you believe or what I believe may turn out to be wrong. So if you have that philosophy, like, here's what I think, and I say this all the time as an investor, like right now I'm saying, gosh, it seems crazy to me that markets have recovered as much as they have. But that recovery is an example of why doesn't pay to make predictions. Or if I say, I think this is what the summer is going to be like, but it's likely that I'm wrong because, you know, things are so unpredictable. I think embracing that kind of attitude and focusing on the things and decisions that you can control is a good antidote to the uncertainty and kind of volatility of not only the world around us, but, you know, the emotions and feelings that are around us as well. So we took up, you know, at least 35 minutes of your time, but we want to leave some time for questions. And if we wrap up early, that's great. But we would love to hear from you if you do have any questions. And I'm just going to check my email right now. Melissa, would you have any comments before we check in on questions?
No, I think that was a great presentation and very informative. I'm looking forward to seeing if there's any questions on them. And I, as Melissa said, I think one of the biggest things to stress is we are giving, you know, the information that we have available through Raymond James, which is phenomenal. But at best, these are all predictions. And again, not knowing exactly what the future holds, but to give you our best estimate and the information that we have available.
Yeah, I would just mention in addition to that, that I think that the work that we do is so important, and it fits in good times and fair weather. And it's not like we're special. It's just that we fit what we do with people, our service offerings with financial planning. But if there's an example of a time when financial planning is valuable, I think, you know, you just have to look at the difficult markets and moments. And we would encourage you, because so many of you who are attending today, and we had great audience great response, and we know people are here. Whenever you feel like you have a question, we want to be talking to you. This is really a helping profession, and it's really helpful. Not that we have every answer about what's going to happen next, but we can talk through, you know, the areas of your personal financial plan so that we know exactly, you know, kind of what you need and how the rest of the world that we can't control fits into your personal circumstances. So it just feels good to have those resources. And I've been so appreciative to have the opportunity to talk with so many of you through all of this, you know, and it's certainly not over. So we'll keep the communication coming, both in our blogs, our podcasts, these webinars, and our newsletters. I don't see any questions though. So I will, you know, just mention, if you want to follow up with either of us personally, we would love that. Here is both of our contact information. This is a little preview because we're redoing our website. So you'll be seeing a new website coming up. Ooh, I did get a question. Hold on.
Right.
Okay, if most of us are supposed to sit tight and not overreact, who is it that does keep moving the market on one item of news or another? I love this question. Thank you.
It's a great question.
So here, we only get to learn about these things with the benefit of hindsight. And, you know, in some cases, you never end up knowing. So I would use the example of the crash of 1987. I've read books on it. Nobody really knows. But what I would mention is, first, there has been very strong personal investor behavior, and we can see that data in information that has been released by 401k providers. So the one in particular I think of is Empower, and I believe Fidelity has had some research as well, that personal investors have not been moving aside from the market. So that was information that we learned about in early March. Also, you know, we've always said that the market is a voting machine over short periods of time and a weighing machine over longer periods of time. And there is that, you know, kind of jockeying and trending for voting. You know, when any sort of whiff of good news, people are anticipating it. I do think that the stimulus is making things happen with big institutional money. And also, if there were areas and segments of the market that were over trading or maybe perhaps unsophisticated or had a lot of leverage, you can't be overexposed once good news starts to happen. So I know that's not a very specific answer. I can't say, you know, there are theories of this government's private fund is helping to have the market go up. And I would also say it's a little bit exaggerated because you're seeing the largest companies, and those largest companies are dominated by some of the best sectors in terms of the positioning. So it's not quite as broad of a rally as it might seem when you hear or see the evening news. I mean, NASDAQ is positive or has been year to date, and that's a much more narrow group of stocks. Is there anything you would add, Melissa?
No, I would say it's a natural feeling too. I think sometimes, people's, it's so hard. We know from the past that it's best to sit tight in markets like this. And, but when you see, the market going up and down, you wonder, who are these people? Are the people going to cash? Are they going back in? Are they timing the market? Again, what Melissa said, you can just look back to investor behavior and what we know over the past market downturns that we've seen is that sometimes recovery happens quickly when you're not expecting it. And if you do try to time the market or, pull in and out, you will miss that. And I see it time and again with,
the month of March is all you need for those types of lessons. If you just did an entire, dissertation or financial history course on March of 2020, I'm sure it will be taught in textbooks for years to come. I personally was reaching out to my mentors, like I talked to Dan Boyce, who mentored me over the years. Just, is this what 1987 felt like? Because I'd never, even though we'd gone through 08 and 09, I was a key investment decision maker at the time. I just hadn't seen the volatility and the swings that we were seeing in that month. And that's not to say that they won't go away in the future. So keep the conversations coming. We're doing a lot of content trying to create, we think it's a really effective way to communicate, but that does not replace the value of our one-on-one conversations. I think it just enhances it. And sometimes there's just topics where I'm like, I keep thinking about this. I need to get it out into the world. So, we try to put those into blogs, into conversations. But we want to hear from you one-on-one as well, and are trying to reach out to you as much as possible. We have a couple additional very exciting legal disclosures that talk about all about indexes and things like that. And then we can pretty much wrap up. But thank you so much for being here, and we really appreciate you and are glad that we can be a part of your community. Thanks a lot. Melissa, thanks for your time too.